Oh, it is indeed the most wonderful time of year for Canada's big banks and for journalists like me, because December is when the Big Six release their annual financial statements, which are like these 6 beautifully wrapped holiday puzzles for which the solutions tell you how these megacorps made all their money for the year. And together, they made a lot more money than expected.
Royal Bank, National Bank,
Scotiabank,
CIBC, BMO and TD all beating earnings expectations in their latest quarter.
Look at these profit margins for the full 2025 fiscal year. National Bank, $4 billion. Scotiabank, CIBC, BMO, all doubling that. Then there's RBC and TD, each pulling in a massive $20 billion in profit. Now, some of that are one-off cash infusions, like when TD earlier this year sold off its entire stake in Charles Schwab for a little over $15 billion US. But the fundamentals are all pointing in the same direction, with big banks almost without exception making more money in 2025 than in 2024. And you can see what that growth has done to their stock prices. They're all up year to date. Scotiabank, TD, CIBC, National Bank, BMO, RBC. The smallest relative gain here, still up 25%, all having recovered and then some from when stocks took a nosedive earlier this year. So back to the original question, how did these Canadian banks, which together own more than 90% of all banking assets in the country, how did they rake in all this cash? Well, some of it comes from big business, but some of it comes from you, and I'll show you how. So when you think about the most common ways the average Canadian might interact with a bank, like just think of your own finances. Maybe you've got a savings account, maybe you've got a mortgage. Let's take those one at a time. What do you make on that savings account? And let's go all out. We're gonna make it a high interest savings account. The most common rate right now at the big banks is 0.55%. But then let's consider the mortgage. What's a 5-year fixed costing you these days? A decent rate might be somewhere around 4.5%. So for every $100 you loan the bank by depositing into your savings, they're giving you about 55 cents a year. For every $100 the bank loans you, you're giving them $4.50. This differential is a core part of how banks make money, and it's how they calculate their net interest margin. As a percentage spread, that's just what they call the average gap between what a bank pays you on things like deposits and what it charges you on things like loans.
Given that the margin is rather small, if you take a small margin, but you multiply it by a large number of transactions or a large number of people involved, that adds up to a very big number.
And sure enough, when I go through these annual reports, take Scotiabank, for example, the money they took in from the lending side of their business in 2025 was $21.5 billion, driven in large part by a higher net interest margin. And we can see the increase this year over the last. Scotiabank's net interest margin is up from 2.16 to 2.33%. RBC from 1.54 to 1.62. CIBC up. BMO up. Again, not earth-shattering amounts on any individual level, but over time, over collectively large amounts of money.
Even though it seems like a relatively small, percent of percent, when you start talking about a couple of $1 trillion worth of assets, a percent of a percent turns out to still be an absolutely enormous amount of money.
Banks work this spread like a lever. And anecdotally, you've probably noticed when banks do this, like when the Bank of Canada decides to hike interest rates. Mortgage rates at the big banks tend to fly up too, right? But weirdly, I don't know if I've ever seen my conventional savings account rate go up at quite the same clip. Like TD's everyday savings account rate. At 1/100th of a percentage point in interest right now, if I wanted to earn $1 a year in bank interest, I'd need to give them $10,000. But let me tell you another thing, that big banks have actually been padding out this spread in even more ways than you think. For example, you know how mortgage rates are often advertised as prime plus or prime minus? So if a bank is advertising a mortgage rate at prime plus 1, all that means is that the rate will be whatever the prime rate is plus 1%. Right now, the prime rate is 4.45%, so a mortgage advertising itself as prime plus 1 is offering you a rate of 5.45%. But where does this magical prime rate come from? Well, I can show you. The prime rate goes up and down in near lockstep with whatever rate the Bank of Canada sets. So when the Bank of Canada sets that rate, called the overnight rate, that's the cue for commercial banks to set their prime rate, which they base their other interest rate products on. But let's zoom in on this premium that banks are charging. Back in 2001, the spread between these rates was 1.75%. Bank of Canada sets its rate at 5.5%. The big banks set their prime at 7.25%. That's how they make money off loans. But notice something very sneaky happens here, 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 and here. 2008, this spread between overnight and prime grows to 2%. 2015, the banks charge even more. Now it's 2.1% above. A few months later, 2.2%. And just a couple of months ago, we see the spread 25 basis points higher. The big banks setting their prime rates 2.45% higher than the Bank of Canada's rate. And so, whether it's because of mortgages up for renewals at higher rates this year, or businesses taking out more and bigger loans because the economy is doing well, or these fatter and fatter margins banks keep stretching out, what this all adds up to is an absolutely core feature of every big bank's bottom line. Almost every single major bank counts net interest income as a driver of at least about half of their overall profitability. But let's talk about that other piece of the pie, that other way big banks make big money. So money lending is obviously an important part of how banks make money, but money moving is just as important. And the most common way people like you and me experience that is through fees. Banks can charge fees to open an account, to close an account, even to maintain an account. Drop below a minimum balance, that's a fee. Exceed your balance, that's another fee. There can be fees for requesting records or requesting paper records, fees to send money, receive money, cancel a transfer of money. You've got transaction fees, service fees, even convenience fees, annual fees, ATM fees, late payment fees, loan refinancing fees, foreign exchange fees, checking fees. You want a certified check or a bank draft or a money order? Fee, fee, fee. Look, the point is, there are a lot of them, and all the fees I just mentioned are only the ones you might consider everyday banking fees. There's a whole other class of fees that spiked in 2025 for Canada's big banks, which we tend to see when markets get moving.
The TSX seems to be quite strong so far this year.
The stock market today hitting another record, wrapping up a big comeback in the second quarter for stocks this year.
Banks are like grease for the wheels of the economy. When those wheels are spinning, banks are involved on every turn. When we think of this largely fee-based income, non-interest revenue, we see the biggest gains this year compared to last under trading revenue, investment management, mutual funds, and underwriting and advisory fees. Those four things account for about 3/4 of how BMO, in this example, made $1.4 billion more in non-interest revenue this year compared to last. So let me translate that, because for the low price of only a small amount of financial geekery, I can show you how booming stock markets really drive bank profits in these 4 ways. We'll start with underwriting, which is what happens, especially in good financial times, when big banks feel confident enough to take risks with your money. Like in October, when this mining company sold $144 million worth of stock, but not to the public. They sold directly to the Bank of Montreal and a group of underwriters who all agreed to buy the whole shebang, not for themselves, but on the assumption that they'd be able to turn those same stocks around and resell to other investors. You can take that risk if you're pretty sure the stock market's in a good place and if you tack on a healthy fee along the way. And some of these deals can get pretty big. Want to know how RBC pulled in nearly $3 billion in underwriting and advisory fees this year? They publish these transactions online, sometimes as an underwriter, sometimes as an advisor. But speaking of RBC, their two biggest revenue streams in non-interest income, accounting for an extra $2 billion in 2025 compared to the year before, they fall under investment management and mutual funds.
They'll take commissions on the wealth management that they undertake on behalf of some of their richer clients, and they always get a percentage of the action.
That's right. Like, if you've ever bought a mutual fund from a big bank, you're probably, hopefully, aware of these management expense ratios, or MERs, that they charge. They can be fractions of a percent on the total value of your investments, or even a few percent paid annually, which over a long enough time frame can equal millions of dollars in fees, even from the most casual of investors. Such is the value of how percentage fees can compound. And so, it should be pretty self-evident that when stock markets are doing well and these funds, these groups of stocks become more and more valuable, bank profits from managing these funds can soar astronomically high.
We have seen over the last generation banks shift more and more into this investment banking and wealth management end of the business. They're less interested in the bits of money that they can make off mortgage lending and other basic services to most Canadian consumers. They're much more interested in the big money that's going around the stock market and the other investment arenas.
And even that is to say nothing of maybe the most obvious way a bank might make money from a booming stock market, which is to take all of the money that they've made from interest and loans and fees and services, and then use it to play the stock market themselves. CIBC, for example, their single biggest line item when it comes to non-interest income, gains from financial instruments, which is basically referring to what their own investments are worth. $4 billion in reported income for 2025, a jump of about $800 million over the year prior.
So the big gain in profits that the banks earned this quarter was a bit of a capture of the cream that's out there right now on the stock market. And we've seen a big surge in stock market prices and speculative gains and capital gains, and the banks have their own piece of that action. They are actually investors in their own right, and that has been the big driver of their better than expected profits.
So look, it doesn't matter which major bank you do business with, they all made money hand over fist in 2025, and collectively almost $20 billion more in pure profit than they made in 2024. Is there anything wrong with that? Not necessarily.
Structurally speaking, profitable banks not really a problem. The distribution of those gains in society can become a problem in the long run.
Yes, because one long-standing critique of Canada's banking sector is that a relatively small number of very large companies dominate the market. So, if you want to see Canadian businesses do well, they certainly are. But if you want to see Canadians themselves benefiting from competition, from stronger services at lower prices, there's room for improvement.